let's start off with the investing side first. Part one, which stocks would I say have got 100 to 500% return? I mean, am I crazy? Who the hell says figures like that? Well, until the markets crashed, I would not have said figures like that. But there is a reason why I think those things are suddenly feasible. So that's part one. Then part two, we'll look at trading strategy. I'll give you, out of my 10 trading strategies we have in the hedge fund, the very earliest one, which was given to me by Bill Lipschutz. Don't buy the book. He was in my book, Mind of a Trader. Can you all see me pointing at the book on the screen? Lessons in trading strategy from the world's leading traders. So you're going to get in this webinar lessons in trading strategies from the world's leading traders as published by Financial. Not the book. You're going to get the actual strategies. I'll give you a chapter from the book as well. But don't buy the book. I get £1 in royalties. It's 20 years old. But the point is, I interviewed 10 of the world's leading traders, as some of you will know. They were then in the book. That's how I got to meet them 20 odd years ago when I was a poor student. And as a result of which they became my mentors, advisors, and I was able to set up my asset management company. We now also have a private equity fund. I'm proud to say, well, actually more than one, several, but I won't go into all of that. You don't care about all of those things. Part three, we'll go through a business plan on what kind of returns you should be expecting. I want you all to start off with a demo account or the smallest amount of money possible, please. I do not want you starting off with crazy sums of capital for a very simple reason. I do not want the brokers taking that money off you. Now, other people will tell you, hey, bet £3 a point. Whether you're doing CFD, spread bets, futures, options, doesn't matter. All gets translated in pounds a point. And what people will do is they want you to do that because they've got a kickback from a broker who's going to get lots of money for making sure you trade lots with them within the space of a month. I don't want you doing any of that. Pick whichever brokers you want. I've got my views on brokers. I can do that in the Q&A. Okay. Now, why do I think, and sorry if I'm going a little bit quickly, the reason is I've got so much information. I was up till 3 a.m. going through the banking reports because we get lots of reports from, like I said, likes of Goldman's, Morgan Stanley, UBS, and so on. So I like to go through them with you guys. Now, why do I say those ridiculous kinds of returns? Well, if a stock has fallen 80% and it goes back to where it was 3 months ago, because it's in the last 3 months, it's fallen 80%, you increase your money fivefold. Okay, so if it goes from 20 back to 100, you've increased your money fivefold. If it's dropped 90%, you've increased it tenfold. But hang on, there might be a reason why it's fallen 90%. It's heavily indebted. And by the way, when are you going to get these returns? Okay, so what's the timeline? Now, for me personally, if I get a fivefold increase, actually, forget fivefold. If I just double my money in a year, I'm happy. Okay, of course, I'm bloody happy. If I double it in 2 years, I'm still happy. If I double it in 3 years, I'm still happy. Got it? So my point is, timelines are less of a problem on this first part of the webinar, which is the investing part. Okay, we will look at how do we decide what to get into. And the base on which we're going to decide what to get into is several things. First of all, I'm going to look at the reports I'm getting from the banks and simplify them for you and give you names of equities that I like and approaches that they use. So it's not just going to be Alpesh Patel's strategy. What the hell do you care about my strategy? Okay, what you care about is actually what's Goldman Sachs telling their richest clients? What are they? What's the inside track there, mate? And I've been doing this for 20 odd years. In my Financial Times column, my Diary of an Internet Trader column, I would take data from the big banks and I would give it to private investors. I'm sort of trying to be like the Robin Hood. This is just an extension of that. And during COVID, it's really very much in demand. I'll also give you and tell you about my Telegram channel, which I've not put up. Let me put that up. Which will give you on your cell phone, you'll be able to get access to some of this stuff as well. Okay, and that's freely available as well. That's the Telegram channel. Most of you may not have seen it. So as well as giving you sort of news on what's happening on the markets, it'll also show you what we're looking at specifically, where the market, sort of what the news items are that coming up, but also specifically what we're looking at right now today for the next set of signals, but it'll also give you overviews on what's happening and moving in the market. So I'll make sure you've got access to all of that kind of stuff. So as well as data, what companies we like, why we like them, how we pick things, and that's freely available. So, you know, we're not a brokerage. So it's not as if we're saying, hey, open a brokerage account with us. It's nothing like that. It's just sharing some of this data with you. Okay. Don't worry about that one. What I want to show you is why I think we might get a double dip. The markets have risen somewhat from this low point over here. Okay, they rose from that low point over there, but in the past, whenever they've done that, feel free to take a picture of this. It's a lot of information for you to take in. But in the past, when they've done this, what they've tended to do is rise a little bit and then fall below the low. In other words, they rarely make a V shape. They normally do something like this. That's what research from Goldman's has also showed. as well. I'll give you the URLs for the book and all that kind of research shortly, but it's just so you know. That's what I'm expecting. So if I'm expecting that, what are we looking at? Well, I don't think it'll go as low as 3,500, but you can see why that would be a reasonable presumption. When in the past we've been at the current levels, we have managed to go as low as that. Goldman's also reckon that with an event-driven average decline, the average is 30%. Well, we've already hit 30%. This is not average though, is it? Therefore, I would expect it to drop more than that. The average length for an event-driven decline is about 9 months. Well, we're only 3 months into it, so it's another reason why I think we might go lower. And an average time to recover is 18 months. Well, I think that might be shorter because the amount of money the government's pushing in. So let's look at strategy number 1 for investing at the moment. Now, at the moment, our strategies are not the usual strategies. And the reason is because these are not usual times. You've got to have a master strategy to pick your sub-strategies. That's something we do with algorithmic trading as well. We've got that's what self-learning is, by the way. That when people talk about artificial intelligence, that's what they mean. It means you can learn. In other words, you learn what the environment's like at the moment. So let's just talk about human intelligence for a second. And you say, you know what? The normal strategy of looking at PE ratios are the most stupidest thing you could do right now, because who the hell knows what the earnings are going to be? Nobody knows. All bets are off. Okay, first time in history that's ever happened. So what are we going to look at? Well, strategy number 1 on the investment front is I put together this table which shows the biggest S&P 500, so the Standard & Poor's US stocks, the biggest ones, and the amount of big funds, reputable funds like Warren Buffett's Berkshire Hathaway, who are buying into these companies. Bill Gates's family office, who is buying into what? Okay, so it's giving that kind of information on here. And what we're finding is, and this was a surprise to me, United Health, I hadn't even heard of them, has got the most support from big institutions. So suddenly I'm interested in United Health, but wait a minute, how much could I make from it? There's no point buying into something if it's only going to give me a 10% return in this environment, obviously. Because if things have fallen further, then I've got to balance reward with risk, of course, and this might be just really low risk, so the reward's not that great. Amazon, Berkshire Hathaway, you can see, Booking, Fox, Viacom. So let's look at some of these, because these are clearly ones that we found that the biggest institutions have invested in. And on my Telegram channel, I often update these regularly as well. By the way, just on that issue of how much capital people have got, obviously quite a few of you have got over $10,000 you might have in a SIP. This is, can't give you pension advice, okay? So I don't want you to think that. When we look at the trading part, I want you to remember that when I hire people in my company, I start them with a demo account, and then on the trading side, and then I give them $1,000 on an account to learn the skills that I'm teaching you guys to trade with. Why? If they're working in a hedge fund, would I start them with $1,000? Because we hire people who've never traded professionally before. So I'm not going to give them real money, because it's my bloody money. Or my clients' money, institutional money, the investors in our hedge fund, our pension funds. Aegon are an investor. AXA are an investor. I can't say to AXA and Aegon, oh, I've got a kid out of school at 18. I'm going to teach him how to trade. Can we borrow some of your millions? They'd shoot me. So I give them $1,000, and that's enough to start with. And we'll show you how to start with that and what the kind of returns might be, let alone if you've got 10,000 and so on. Let's go back to investing. I apologize. Forgive me if I'm jumping around. There's just a lot of stuff in my brain to give you. So when we look at some of these equities, what kinds of things am I looking at right now? Well, normally, under normal circumstances, I would never, ever, ever care for analyst predictions, because as I've written in my Financial Times column, analysts are biased towards the buy side and they're trying to flog you stuff. At this time, it's one of the few things which matters. Suddenly, if we're talking about self-learning, okay, suddenly what we've discovered is that factors which were irrelevant in normal times are suddenly far more relevant, such as what analysts are telling their wealthiest clients, right? Because obviously the wealthiest clients are thinking, well, I can't rely on earnings. What can I rely on? Oh, I know what targets the guy from Goldman Sachs is giving me, or Morgan Stanley, or whatever. And so Disney, by the way, if you followed my webinars You'll know there's some companies I'm going to mention. I didn't happen to mention Disney, so I'm not going to take credit for that. I did on the trading side, but not on the investing side. Goldman Sachs just said, I think 2 days ago, that's on their buy list. And there's a whole bunch of other banks, strong buys, 14 of them. And this is the average price target of all the analysts. Some think more, some think less. That's a 44% upside. But you might say, Alpesh, Disney's a safe company. That's why I'm only getting 44%. And that might be suitable for you, let's say over a 12-month period. Even if it took 2 years. If you got a 44% return over 2 years, you might be happy, okay? But you might not. You might say, Alpesh, go on, give me the good stuff. Give me the top shelf stuff, mate. Give me the stuff you're keeping for yourself. You know, it can't be Disney, can it? You must have some good stuff up your sleeve. Well, okay, let me show you something else. You know, open up my coat a bit. How about Uber? Again, Goldman said it a couple of days ago. This is on the investing side. And again, you might say, nah, Alpesh, I want a bit more fuel, if you know what I mean. 55% on the upside from what the analysts are saying. It's not what Alpesh is saying. This is not Alpesh's magic formula of, let me draw some lines and Fibonacci's and I discover. No. We're going by, we are trend following. We are going by what self-fulfilling prophecies the market themselves might be going to. Now, if you want a story behind Uber, I can give it. But this is based purely on what the big banks are saying. I can give you a story. My wife said to me yesterday, when all this is over and she's going to work, she ain't taking the tube. She's going to be Ubering it. Mr. Patel, you better get working. You're going to have a big Uber bill. And then I thought to myself, well, okay, there's a story. I bet a few other husbands and wives and children are all saying the same to their family members. Maybe that's why it's going to spike up after this is over. But I don't care for stories. What I care for is this. Okay, but Alpesh, go on. Bit more top shelf, Alpesh. Bit more good stuff. Viacom. Now, 190% to the upside. This is grade A stuff, yeah? You might say, hang on. That's a bit too much, Alpesh, bit too tasty. Where the hell did you pull Viacom from? Well, I'll tell you where I pulled it from. When I was looking at the list of the biggest, so what Berkshire are owning, what some of the biggest banks and funds are owning, there it is. It's right up there alongside Fox and Booking. Booking owns not just Booking.com, but a whole bunch of other travel websites. You can imagine why some of these have fallen. But hang on, Alpesh, they've fallen. And they go back to 190% over whatever time frame. And I mean, price earnings, I appreciate, are pointless, but 2.4, nobody's going to be paying dividends. Kiss those goodbye. Companies are going to be storing those up. Okay, so that's Viacom. Give me something else. Fox, as you just saw, 90%. Maybe that's a happy balance. Clearly not going to go under. Not much on the analyst side, but there you go. All right. So that's one thing, but that's only one thing. And you might say, well, what about the UK ones then? We'll come to that. Okay, we're going to come to that. Don't worry. Thank you very much, Patricia. We're going to come to that. This, by the way, is United Health Group. Maybe one of the safest. So the point I'm making to you is there is safety if you want it. You can have lower risk. S&P 500 company, one of the big mega companies of the United States, and 33% to the upside. This is all in dollar terms. Now, you might say, hang on, Alpesh. If the pound starts appreciating, what then? Well, I'm just talking dollar terms. I'm going to keep it simple for now. I don't mind owning dollars. In fact, I like doing it. Now, let's just go back. Don't worry about all this other stuff. I will always translate these things for people anyway and what the important things are. So you always get lots and lots of data and people go, what the hell? I don't need you to have a PhD in finance. That's my job. I will translate things into simple terms. This is from the Financial Times. This is another reason why I think the markets yet have another leg to fall down on. Okay, another leg to fall down on. And the key reason is this data. We are, for the US, just starting to accelerate. They're going to get more deaths and more bad news, sadly. Now, when I was at university, I read politics and economics, and I can tell you from a political cultural perspective, the Chinese can stamp down on their citizens. The Americans can't. Okay, I used to work in the US Congress, and I can tell you, and no offense to Americans, I hope one day to be one myself, admire them, but I can tell you a country which cannot, after children are gunned down, ban guns because of personal liberty enshrined in their constitution is certainly not going to be able to keep people indoors in the numbers it needs to, because they believe in personal liberty to an extent, and God bless them for it. But this is the wrong time to have civil liberties, I'm afraid. And so the bad news, I'm afraid, is going to coming in. And I think that's what's going to eventually, a bit like a boxer. Imagine the boxer's Donald Trump, and he's holding up the markets. He's doing the best he can. He's punching out there saying, we're going to be fine. We've got this coming with the greatest country. And that's all great. But he keeps getting punched by bad news. And I think sooner or later the market will relent and we'll get the second leg. However, let's say you're wrong, Alpesh, and pray to God I am wrong on this. Pray to God I am, and tomorrow morning there's a vaccine. Okay? If I am wrong, we still need to have equities and stocks and a strategy which still works. Okay, because we're not gamblers. We want to be having an optimal strategy which works in the market conditions, whether we're right or wrong. Okay, so how do we do that? Now, let's remember when I talk about bottoms that the market decline from peak to trough in the financial crisis was 54%. We've not had that. It was 54%. You can see why I'm making the case for more falls. So how do we protect ourselves? Of course, in the trading side, we protect ourselves, and we'll be trading. We can trade long, short. We can trade short on currencies, so we're not harming any companies. You know, do no evil, but you know. We're not going to make a difference to the global economy in this way. And hopefully if you make some money, you'll donate it to good causes. But my point is, but what about the investing side? How do we protect ourselves from some of those falls? And so my job is to look at the universe of equities and make sure that we've got things which are not highly correlated. You know, some things go up, some things go down. The reason why I am positive, however, that we should be buying is this. Okay, because the issue is not, oh, well, then don't buy anything. Return after 20% market declines. This was from Goldman's as well. 1 year average is 14% up. Now, that's for the overall market. Individual stocks will do a lot better. So let's look at another strategy which will protect us from market falls. Okay, if it falls further, and even if it doesn't, we're still going to start getting in a little bit of our investment portfolio. And there's three things that we're going to look at. We're going to filter. You're going to hear this a lot in this webinar. We're going to filter across three different approaches, so that only if something meets all three criteria would we look at them. And I'll tell you what I own as well in a second. The first thing we're going to filter across, don't worry about this formula. You don't need to learn it. I'm just telling you. It's a bit like me showing you a TV. You only need to know how to flick channels. You do not need to know how LEDs work. Okay, same thing with this. The Altman score, nobody gave a damn about. Nobody gave a damn about. It was invented in 1969. Nobody gave a damn about because it measured the likelihood of a company failing. Suddenly, we give a damn about companies failing. Do you see how self-learning happens and what artificial intelligence actually does? It picks the mega strategy and then the sub-strategies under that. So what does it look like? This score looks at the working capital of companies. Guess what's the most important thing right now for companies? It's working capital. It's their oxygen. And it also looks at how much they've stored before in terms of their profits in their bank accounts. Those are two very important things. The Altman score was devised to determine whether or not companies are likely to go bankrupt. It's very useful in this environment. I'm going to give you the stocks and their Altman scores, but that's not enough because no one indicator, no one formula works all the time. So that won't be enough. The other thing is something which Goldman Sachs uses. I know this because when I had lunch with Lord Jim O'Neill, he was just Jim O'Neill then when he was chairman of Goldman Sachs Asset Management, this is what they pitched to us. This is a screenshot from one of their presentations, and you're going to see other screenshots from presentations provided by hedge funds as well, so that it's not about trusting me. I don't care whether you trust me or not. The croaky is not a formula invented by Goldman Sachs, but it's used by Goldman Sachs Wealth Management to tell their wealthiest clients what to put their money in. If you want to know how they come up with stuff, this is one of the key things they use. Now, not secret in many regards, because I wasn't asked to sign any confidentiality agreements. I'm just telling you. Why is this important? Well, it's cash return on capital employed. Why is that important? Because cash flow is king right now. And this is what Goldman's are using to tell their clients. So I want to know suddenly, well, wait a minute, which companies have got high croakies so I can get a jump on what Goldman's are telling them. And why this is important, as I said, in good times and bad, but really right now, is it gives me an idea of, look at that, working capital's in there, cash flows in there. Got it? It also, whilst it's giving me a return on the working capital, it tells me how efficient a company is at generating cash. If it's good at generating cash, it's going to recover relatively quickly after this. If it's poor, it's a bit like the health of a patient. They've got big lung capacity, they're healthy, they're strong. After they've got the virus, and we've all got the economic virus, they're going to recover quicker. And that's the way to look at it. So let me show you, and this is why I was a little bit late coming onto the webinar because I hadn't set this up fully. This is let's look at the Footsie, oh, for God's sake. UK, there we go. Footsie 350. Well, we were already. The 350 Footsie companies. And let's just look at which ones have fallen the most in the last 2 weeks. In fact, no, forget that. Last 3 months. Okay, let's do the 3 months. Let's move this across. And I want to give you these figures right now. There you go. So Finabla has dropped 90%. If it goes back to where it was, I'd get a tenfold return. But hang on, 2% croaky. That's a bit low. Altman score, high risk of failure there. Oh, by the way, if I freeze at any point on this, it's because I've got so many applications open and there's so much data coming through. Let me just turn my own video off so there's not too much data coming through for all of you. Okay, that might help. And you can always relog back in if need be. Right, so what figures are we looking at over here? What figures are we looking at? So we've got the Altman. Okay, and I want that ideally to have 3. Take a picture of this if you wish. I've got the croaky. I'll try and put these slides up, but I've been so busy. Might take me a while, and I'll tell you where I'm going to put them up at the end, so they'll be freely available too, but I might not be able to do it after the webinar. I've got families to look after as well. Anyway, 84%. It's fallen. So we might assume that in the next year, this is the thinking I want you to do. If in the next year or two, these go back to where they were 3 months ago, what return might you get? Well, 5-fold return on anything that's dropping 82%. But wait, if the croaky, first of all, if the Altman score's so low, they might never return there, because guess what traders are punishing the most? Companies with poor financial health. In other words, I ideally want an Altman. You can see the figures there. Take a picture of that if you wish. Above 3, caution 1.8 to 3. Got it? Take a picture of that. If you're not taking a picture, I'm sorry. And I want croaky to be as high as possible. Take a whole picture of this if you wish. I'm not going to scan through every single one. Now, if you say to me, Alpesh, I'm going to take ones with Altman scores of 1.8. Well, you're taking a bit more risk, but you might get a bit more reward. Right? Let's look at the other end. Look at the ones. Look at this one. Look at plus 500 broker, right? Massive Altman, massive croaky, and it's up 25%. No kidding, it is. Financially healthy, and they're doing well. Polymetal, I'd mentioned in one of my telegrams ages ago. They've got a very high Alpesh value growth rating. All right, the highest there is, 9 out of 10. By the way, my algorithms look at the valuations of companies, their revenue growth. Growth companies are doing the best at the moment. So the benchmark for Altman is ideally above 3, and for croaky, there isn't as such. High as possible, please. You know, if it's in the 20s, it's better. But you can see from a comparison here, very few are in their 20s. So you might ease back and say, well, it's 8.9 Alpesh. Should I do it? Yeah, you're taking a bit more risk, but you'll be all right. And in the last 3 months, it's up 15%. In the last 2 weeks, since I picked it over 2 weeks ago, it's up 30%. So you can see who's getting rewarded. Growth companies, good financials as embodied by Altman and croaky. Okay, so you can see these. Take a picture if you wish. I'm going to scroll down so you've got another picture you can take. Right, there's another picture, and you can see how much they've fallen. Your theory is, if it goes back to where it was, what kind of return might I make? You might say, well, if it goes back to where it was, I don't want to just make a 15% return. Screw that. I want to look at the bottom end of the table, Alpesh. Show me those babies. Okay. Well, these are slightly lower risk. If you've got Altman's at 6 and a croaky, there you go. Hayes, the recruitment agency, you can see why it's dropped 50%. But if it goes back to where it was in a year, you'll double your money. Is it likely to go back to where it was in a year? Guess what? A shitload of people are going to be going to a recruitment consultant. Not now. Right? Because we're all in isolation and we're just, don't know what the hell's going on. But hell yes. Is that likely to double its money? Well, you work it out from what I've told you. I don't need to tell you what's going to happen. I want you to learn. I don't just want to feed you fish. I want to teach you how to fish as well. All right. That's the US equivalent, or anyway. Okay, so you can see which ones had the best croakies and Altmans, and you can see their debt to market cap was, look at this, Abiomed, hardly any debt at all. Why is it only fallen 17%? Well, sadly, you're not going to make more than 20% on that one, but it's safer. Do you see? These are safer. Regeneron Pharmaceuticals is already at an all-time high. So you might think, oh, bloody hell, Alpesh, okay. So do you see the trade-off between risk and reward? The market's not stupid. It knows how to work out risk and reward. I've already given you that one. One of the other things we look at is discount cash flows. That's our private equity background. We apply this into the hedge fund setting, and so we look to see the future cash flows of a company. Have you noticed how I keep saying working capital, cash flow, cash flow, cash flow? I'm a businessman. I'm sure some of you are business people. You know right now cash flow is what matters. What your earnings were 12 months ago, unless you retained them in a bank account, are irrelevant. All right, and what you project they're going to be in the next 12 months, irrelevant. Cash flow. So we look at undervaluations on a discount cash flow base. Don't need to worry about that at the moment. These are things that I actually own. I'm not going to go into details as to why, but I want to give Amazon to my grandchildren. If it falls, I'll just keep buying more. I will sell my mother-in-law if I have to keep buying Amazon. All right, it's as simple as that. Can't get enough. 2 times leverage. Now you might say, well, this is an exchange traded fund. 2 times leverage, not a spread bet, not a CFD, because this is investing we're talking about. If I'm holding something for a year or 2, I don't want to pay interest on a spread bet. So we're still in the investing part of the webinar, right? I also earn 2 times daily leveraged Brent crude oil, which you will know I've made, not just me, but a lot of other people. Didn't take much intelligence to make money on that one. If you're at my Hammersmith talk at Novotel 3-4 weeks ago, you'll note that I had this. You'll also know that I own this, which is Apple for the grandchildren. If it falls, I'll keep buying more. I don't need to have stop losses on Apple, right? Because I want it for my grandchildren. Got it? And this is the Footsie leverage. Now, if you want to know which brokers, well, there's many these are exchange traded products. So many, they're traded just like shares. You can invest in them just like shares. This is all in my SIP, by the way. Okay, that's in my SIP. This is the name of the exchange traded funds, but there's many different varieties. iShares, many companies, they all do the same job. All right. The reason I'm telling you all of this is because I think you can be better than overpaid fund managers. And the reason I believe you can do that is because I was a private investor like you, and I did it, right? I'm not saying everyone's going to win competitions in the Financial Times like I did to forecast the Footsie 100 over a 1-year period. And people like Neal Woodford, who became overpaid fund managers, then several years later have to apologize. We knew in 2004 in the industry, the retail clients are going to get royally screwed. How do we know that? Because he barely beat a cat. He barely beat a cat when it came to fund management. All right. That's how we knew. But would anybody listen to us? Well, what were we going to say? You know, it's like the Me Too movement. Everybody's quiet. I'm to blame for Neal Woodford as well. I didn't speak it up loud enough to say you guys are wrong. I did try and say to people, you should be investing with ours. Now we've got so big, we only take institutional money. We don't do retail clients. We only take institutional funds, no private investors.